Think of India's startup ecosystem as a towering skyscraper. From the outside, the skyline looks pristine, but inside, the foundational pillars are quietly cracking under the weight of their own design. By early 2026, official government records celebrated a massive milestone: over 212,000 recognized startups operating across India. That top-line number hides a massive purge. The ministry officially struck off nearly 7,000 entities, while private trackers show over 11,000 shutdowns. This followed the 2025 funding winter, where total venture capital dropped 18% to $10.5 billion. The mass closures of 2025 and 2026 represent a ruthless market correction, signaling a permanent end to the growth at all costs era. There is a distinct lag between a company actually dying and the government recording its death. Private market trackers log a shutdown the moment operations cease and the website goes dark, while official registries wait for lengthy legal dissolution processes to finalize. Government officials maintain a positive outlook. According to Parliament replies from leaders like Minister Jatin Prasada, a 3.2% closure rate represents a healthy churn, weeding out weak players. But analyzing the wreckage reveals 5 specific pathogens that killed these companies: broken unit economics, a severe late-stage funding crunch, poor local adaptation, weak governance, and the normalization of post-pandemic demand. To build a company that survives 2026, founders have to deconstruct exactly how these specific mechanical failures drove thousands of businesses into bankruptcy. This chart categorizes official closures by industry. IT services lost 875 companies, and healthcare saw 553 failures. Next are edtech, food and beverages, and agriculture. Geographically, Maharashtra alone accounts for 1,200 dissolved entities, outpacing Karnataka. A primary driver for this concentration of failures was a brutal 30% drop in seed funding during 2025, which choked off the runway for early-stage companies in these major tech hubs. The sheer volume of casualties in historically safe, high-demand sectors like IT and healthcare proves a critical point. Strong industry demand cannot protect a business built on broken financial fundamentals. Survival requires one strict equation: customer lifetime value must outweigh customer acquisition cost. Consumer brands subsidized orders, spending heavily on users whose lifetime spending couldn't cover acquisition costs. Venture capital temporarily masked this. When funding evaporated, the scale broke. Founders optimized their entire structures for higher valuation multiples during follow-on rounds, neglecting to build self-sustaining revenue streams. Unprofitable expansion without a continuous venture capital subsidy is not a business strategy. It is a mathematical guarantee of bankruptcy. Byju Ravindran's edtech empire stands as the ultimate case study of these excesses. Once valued at $22 billion, Byju's collapsed under massive debt taken on for aggressive, rapid-fire acquisitions. Combined with severe governance failures, auditor walkouts, and legal battles, the company entered insolvency proceedings. While Byju's choked on debt and governance, hyper-local delivery platform Dunzo suffocated on unit economics. Even with massive financial backing from industry titans like Reliance and Google, Dunzo's core operational burn rate was simply too high to sustain. The capital dried up before the unit economics could balance out. We saw similar capital stress in the EV mobility sector. BlueSmart faced severe operational constraints, forcing temporary service halts as heavy infrastructure costs collided with restricted liquidity. And consumer messaging app Hike proved that executing constant pivots from messaging to gaming to Web3 cannot revive a product without core relevance. It shut down entirely in 2025. These cases strip away a major illusion. Brand equity, theoretical market size, and Tier 1 investors cannot insulate a company from the gravity of economic laws. Operational toxins killed thousands of early-stage attempts. The most common was the copy-paste model, forcing a Western startup idea into the Indian market without adaptation. India's extreme price sensitivity, localized consumer behaviors, and unique infrastructure hurdles meant these unadapted products suffered from severe churn and low customer loyalty. Then came the demand correction. EdTech and consumer service companies that aggressively expanded their server capacity and headcount during artificial COVID spikes suddenly faced normalized demand, leaving them with massive overhead and a shrinking user base. Finally, a sudden tightening of regulatory oversight exposed widespread compliance failures. Weak financial controls and co-founder disputes decimated hundreds of companies, particularly within fintech and digital lending. Treating local demographic realities and regulatory compliance as afterthoughts guarantees that rapid expansion will result in rapid collapse. But the death of 7,000 companies leaves a specific advantage for the survivors. The market is no longer crowded, with irrationally funded competitors artificially driving up customer acquisition costs. Venture capital hasn't vanished. It has redirected. Funds are shifting away from direct-to-consumer brands and hyper-local delivery, deploying instead into deep tech, climate tech, and AI infrastructure. Nearly 50% of new, fundamentally sound startup formations are now emerging outside of the primary tech hubs. As Tier 2 and Tier 3 cities illuminate with activity, the foundation of the ecosystem is shifting geographically. Furthermore, foundational government support mechanisms like tax benefits and seed funds remain actively accessible for disciplined teams. The capital is still there. It has simply matured, prioritizing resilient substance over easily marketed hype. Building in 2026 requires new mandates. First, prove positive unit economics before scaling. Second, optimize for 24 months of runway. Third, ruthlessly validate product-market fit with actual paying customers. Fourth, treat regulatory compliance and transparent accounting as non-negotiable from day one. To survive today, a founder must possess the vision of an industry disruptor, but operate with the rigid financial discipline of a traditional CFO. View these Indian closure statistics against global reality. Historically, 90% of all startups worldwide do not survive their first 5 years. Venture capitalists in 2026 evaluate companies based on verified traction and high user retention. They are ignoring theoretical projections about total addressable markets. For new entrepreneurs, this purge is actually an advantage. The board has been cleared, leaving open lanes for solid fundamentals. If you are starting up today, analyze these 7,000 failures closely. They are incredibly expensive lessons, paid for by someone else. The 2026 startup purge served as a necessary filter, leaving a resilient class of Indian enterprises.